Hello and a very lovely good evening once again to each one of you, and hope that each one of you are absolutely fine. So now coming over to section 3, so we have completed section 2 wherein we took up some very heavy questions. Logically this particular section I have framed for your own attempt, but still I'm going to do that one just to give you a better practice, because these questions are quite important from the examination point of view, needless to say that. And question number 3.1, hope that you must have downloaded the notes. Notes are now available on a YouTube channel, so just have a look over there, and I have written the titles over there also. Those among you, if you are not having the notes, you can download it from there. Accounting common control and acquisition. XY Limited has two divisions X and Y. The draft information of X and Y is as follows. So should not appear as a very tough question to you, especially after having finished up what we call section 2. This question should be almost like a stroll in the park for you. Cost is 800 and 400. This is X and Y, two division. XY Limited is the entity and it has got two divisions. Further, we have been given written down values 200 and 300, and then current asset of 500, 400. Besides that, we have been given current liabilities 200, 300. The written down value and net working capital is added back to give you totals, and then equity share capital of the organization is 100. Other equity actually was not given in the question. Now, if I will subtract, and it was given in the question that there are no borrowings of the of X Limited. So quite obviously, if I am going to subtract 100 from 500, I will be left off with 400, correct? That is why I have written question mark and then 400. Actually, it originally in the question, it is question mark. So you can find it out very easily by subtracting 100 from 500 to get 400. Similarly here, it was given that no equity share capital, but other equity was but borrowings is given 200 and total is 400. So quite obviously, other equity will be equal to 200. So further, we have been given now in this question, Y division is sold to a new company. Y division is sold to a new company, Z Limited, and consideration of rupees 250 lakh was settled by issue of equity shares of Z Limited of 10 each. Past journal entries in the books of XY Limited and Z Limited. So importantly, it is given that consideration of 250 lakh was settled by issue of equity shares of Z Limited of rupees 10 each. Past journal entries in the books of XY Limited and Z Limited. Presumed purchase consideration is received by the members of XY Limited. Further, it is also given in the question. Now, I have already told you this question should appear to you almost like a walk in the park, especially after you have finished up so many questions. Correct? I will keep these sheets somewhere here. Correct? And some rough sheets I may need around the rough sheets. Just wait, give me a bit of time. Where I have kept the rough sheets. That is the only problem. Sometimes when you look out for something you don't get. Anyway, fortunately. So as far as this particular question is concerned, it is given to us there is an entity by the name of XY Limited. This is rough work. If you want to note down, you can. But just I'm opening up the question. There is X Limited, there is Y Limited, two divisions are there. It is also given that Y division is being sold to Z Limited. It is the new company. And Z Limited will make a consideration of 250 lakh. This division is being sold to this entity. Now Z Limited is making the payment of consideration to the members. And question is silent whether any member is having more than 50% stakes in it or not. So in that case, I have already told you that if question remains silent, it is better to treat it as a case of common control on the assumption that this entity is still in our control. Correct? On this assumption, and this assumption will accrue when we shall presume that one of the member holds more than 50% stakes in this particular entity. So always base your solution on common control. If the question is silent when purchase consideration is given to member, take it as a case of common control. but it is always better to write it in the examination that what assumption you have taken. I will keep these rough sheets over here, and now we can begin the question. Section 3, now we are moving over to. Under section 3, first of all, I will write question number 3.1. And now, as far as question number 3.1 is concerned, first of all, I will write the books of XY Limited. This should be your first step. Books of XY Limited. XY Limited, I need not require to tell you, is your demerged entity. Correct? First, you prepare the journal here. This is your solution step 1. Under solution step 1, first you are preparing the journal. Now, as far as journal is concerned, all you need to know is that one of your division, Y, is being sold out. And it is sold out to Z Limited. So your first entry will be to debit the Z Limited, from whom you are supposed to receive a consideration of 250 lakhs. Then you look into the balance sheet, try to find out the liabilities, and if you will go through this balance sheet, we know that their current liability is equal to 300 and their borrowings are 200. Besides, they have net property, plant and equipment 300 and current asset 400. Correct? That's all. So I will write here current liability. Current liability is equal to 300 lakhs. Then they have taken our borrowings. Borrowings is equal to 200 lakhs. Then I will write here to property, plant and equipment. It is always better to write property, plant and equipment at net value. If you are writing at gross value, put the depreciation over here then. Write to current asset. Current asset is your 400. Then take the balancing figure as profit and transfer straight away to the capital reserve. Correct? Your capital reserve will be equal to 50. This will be your balancing figure. Transfer of assets and liability is the narration. Now, since this consideration from Z Limited is not received by this entity, so we are going to debit capital reserve or reserve in surplus. Because you are having a capital reserve, it is better to debit capital reserve. Otherwise, you can write reserves in surplus also. Capital reserves account debit 250, because 250 crores worth of consideration will not be received by us from Z Limited. It will be received by the members. Correct? You can write instead of capital reserve, reserve and surplus also. Ultimately, your other equity will fall, no doubt about that. Now we'll prepare balance sheet. Balance sheet of XY Limited. Balance sheet of XY Limited, of course, after sale of division. First you write assets. Under the asset you write non-current asset. Under non-current asset write your property, plant and equipment. You have taken property, plant and equipment for rupees 300. Property, plant and equipment, 300 worth of item has gone out. Now the division which we are left up with is X division. Correct? So we will see, because this division has moved out, so we are left up with X Limited. So I will write here 200, because now XY Limited is having only one division and items of that division only will find place in the balance sheet. Similarly, now I am going to write current asset. Current assets of X Limited is 500. So 500 I will write here. So 700 will become the total of asset side. Then I am going to prepare equity and liability. equity and liability. As far as equity and liability is concerned, first write equity. Whenever we prepare balance sheet, in the balance sheet we write share capital of the organization. Now share capital of the organization is given to you as 100. Correct? Then you write other equity. As far as your other equity is concerned, remember your equity was 400. Your equity was 400 and equity of division Y, which has been sold out, is still with you. Why it is still with you? The reason is that when we sell the division, we sell the assets and liability. We never sell the other equity. Is it clear to you or not? So that is why 200 plus 400, or you can simply straightway take the equity of the organization 600. However, when we pass these two entry, our capital reserve first got debited. So I will subtract 50 due to capital reserve debit, and capital reserve first got credit, sorry. So I will add 50 and then it got debited by 250. So now my other equity position will be like this. Ultimately it will be equal to 400. Correct? It will be equal to 400. Now I will keep this sheet here, otherwise it is becoming problematic. Now I will write here liabilities. As far as liabilities are concerned, first non-current liability. Under the non-current liability, there is no item of the organization, current liability. However, of division X is 200. So I will write here 200. So total will be 700. This is how the balance sheet after demerger will look like. Correct? Simple, no problem. And should not be a big problem for you. You can manage this question by yourself also, because we have done now so many questions. Now we move over to step number 2. Under step number 2, I will write journal of Z Limited. First of all, let me write books of Z Limited. Books of Z Limited. As far as books of Z Limited are concerned, first we are going to prepare the journal. Now Z Limited is the new company. New company has taken over our division Y, and as far as division Y is concerned, its property, plant and equipment was taken over at 300. Its current asset, division Y's current asset was taken over at 400. Then current liability of division Y is equal to 300. Let me check. Right, it is 300. Then borrowings of division Y is equal to 200. To consideration, division X will make a payment of 250 lakh. So that makes it 750 minus 700. So it is a loss. But don't write goodwill. So often I have told you now, better write capital reserve only, because if you will write goodwill, it means you are recognizing a new asset. And Appendix C of India Standard 3 does not allow that. So write here consideration. Consideration account debit. 250. Z Limited will make a payment of 250, and the payment was made by way of equity share capital. So these two entries we shall have to pass. Now we can prepare the balance sheet. Balance sheet of Z Limited. As far as balance sheet of Z Limited is concerned, assets, non-current asset, first of all you write. After writing non-current asset, property, plant and equipment, 300. Only one other item, current asset, that again is 400. Total is 700. Equity and liability. Equity and liability. One, equity. Under equity, write share capital. Since Jet Limited has issued share capital worth 250, so you are going to write here 250. Then you will write here other equity. Z is a new company. No question of any previous equity. But here we are having capital reserve and it is having a debit balance. So capital reserve is having a debit balance, you will write it as a negative item. Then you will write here liabilities. As far as liabilities are concerned, non-current liability. Yes, there are borrowings. You have taken over borrowings to the extent of 200. And then you have taken over current liability to the extent of 300. 500, 750 minus 50, 700. So this is how the balance sheet of Jet Limited will look like. So this is your question number 3.1. I told you that you could have managed this question of your own. Now we pick up another question, but this question needs a bit of what we call understanding. Although initially it may look that you may be able to do it by yourself, but there is something else which is also asked in this particular question. Max Mini Limited. Max Mini Limited is having two divisions. Max Mini Limited is having two divisions. Let me keep the rough sheets also so that it becomes easier to make you understand. Correct? Max Mini Limited has two divisions. And it is given to you that Max Mini Limited, the draft information of assets and liabilities is as follows. Max Mini Limited is having Maxi division and Mini division. This is the total given to you. And there is nothing for me to actually discuss over here anything, because as you can see, it is similar to the last question. Property, plant and equipment of both the division at gross value is given, then depreciation is given, then written down value is given. Similar to the last question, current asset, current liability is given, net current asset is given, total is given. Further, it is given that total assets are financed by loan funds. Now, there are no loan funds of Maxi division, but of Mini division 100. So, organization's loan funds is equal to 100. And then we have been given actually equity capital 50 of the organization. We are not given equity capital of Mini division. Moreover, we need not require to find out equity share capital of Mini division. It is as simple as that. Reason is that we will see later on that this Mini division is being sold out. And moreover, in the new balance sheet, in the demerged entity, when we write what we call equity share capital, we write the organization share capital. So I'm least concerned with that. Correct? Number one. Number two, reserve and surplus again is not given. Again, I am not concerned with that. The reason being is that when in the new balance sheet of demerged entity, I will write reserve and surplus or other equity as we call it nowadays. I will take the organization and moreover, we take the other equity of both the entities. So we can straight away take 650. So we are not bothered about regarding these two items. Is it clear to you or not? Yes, sir. It is decided to form a new company, Mini Limited, to take over assets and liabilities of Mini division. So now the question states, and question itself in the starting stage itself is quite confusing. it is decided to form a new company, Mini Limited, to take over assets and liability of Mini Division. Now, what does it mean as far as 3.1 is concerned? 3.2, sorry. One was this one. Now here, the name of the company is Max Mini Limited. Name itself is quite confusing. This entity is having two divisions, Maxi Division and Mini Division. Now question states that this division has been sold to Mini Limited. To Mini Limited. So don't get confused. This division is sold to Mini Limited. It is decided to form a new company, Mini Limited, to take over assets and liabilities. In fact, Maxi Mini Limited has formed a new company to take over assets and liabilities of this division. So point is saved. Now, I will keep these sheets here. Further question says that accordingly, Mini Limited was incorporated to take over balance sheet figures, add balance sheet figures, the assets and liabilities of that division. Mini Limited is to allot 5 crore equity shares of 10 each. So it is allotting actually 5 crore shares of 10 each. 5 crore shares of 10 each. That makes it 50 crores. 50 crores, correct? And this time consideration is given to the members of Maxi Mini Limited in full settlement of the consideration. Consideration is being given to members of Maxi Mini Limited, correct? The members of Maxi Mini Limited are therefore to become members of Mini Limited as well without having to make any further investment. Quite obviously, when members will get the share, they will also become what we call members of this company, new company, and they need not require to invest anything out of their pocket. Are they purchasing the shares? Shareholders are not going to pass any such entry shares in Mini Limited account debit to bank because they are not giving any back. So it is normal common line. Whenever the shares will be issued to members, the members need not require to churn out anything out of their pocket. Correct? And further it is given you are asked to pass journal entries in relation to the above in the books of Max Mini Limited and Mini Limited. Also show the balance sheet of the two companies on the morning of 1st of November 2023. Till up to this stage, this question is on similar lines. Further, it is stated that directors of the two companies ask you to find out the net assets value of equity share pre and post merger. So directors of the company are interested in knowing the value of what we call equity share before and after. And further, last question states that comment on the impact of demerger on shareholders' wealth. So due to this merger, demerger, whether shareholders are really having some advantage or disadvantage, we want to know that. So these are the two extra things which have been asked in this question. Is it clear to you or not? So I will keep this sheet over here again. So many sheets are there, sometimes it becomes a bit of problem. Okay, so even rough sheets can be kept up over here. So 3.2, now we pick up. 3.2. Question number 3.2. And first of all, books of Maxi Mini Limited. This is the demerged entity. Now, in order to frame the books of Maxi Mini Limited, first of all, I need to prepare the journal. This is our step number 1. We are preparing the journal. They are taking over, out of Maxi Mini Limited, one division is moving out, correct? And we are selling this division to Mini Limited. So first of all, I am going to debit Mini Limited. And Mini Limited has promised us to pay 50 crores worth of consideration. Now we will take into account all the liabilities. As far as liabilities are concerned of Mini Limited, we can find out one is loan funds 100 and there is current liability 100. Besides these two liability, current assets are 300 and written down value of property, plant and equipment is 200. So we have to keep track of these four items to pass this entry. Loan funds. As we saw loan funds are 100, then current liability account debit is 100 again, current liability is 100, right? And then we will write here to property, plant and equipment. Property, plant and equipment at net value, which is available over there in the question, 200. And current asset. Current asset given in the question of this division is equal to 300, I think so. 300. So that makes 250 minus 500. So balancing figure is over here. So I will write here loss on reconstruction account. Balancing figure. That is your 250. Because it is a case of loss, so loss must be set off. In order to set off the loss, I will write here reserves and surplus or other equity. Reserves and surplus account debit to loss on reconstruction. Loss on reconstruction. 250 and 250. So loss has been set off now. Further, now Mini Limited will pay the consideration, but that consideration will not be received by us. So once again, reserves and surplus will have to be debited. Reserves and surplus account debit. That is equal to 50 because loss is 50. To loss on reconstruction account. 50. So loss, because of the fact, sorry, I have written here loss on reconstruction, extremely sorry. In fact, I will write here Mini Limited. Mini Limited will be credited, but we are not going to receive the amount, correct? That is why there is a loss. So as far as Maxi Mini Limited is concerned, you can see that these are the entries which we need to actually pass, correct? Now, the next point is with respect to preparation of balance sheet. Assets. So, only one division is left up with us, that is Maxi division. We will consider their accounts only. Non-current asset. Property, plant and equipment at net figure of the division which is left with us, that is Maxi division. 100 is the written down value as you can look into the question. Second, current asset. Current asset of Maxi division is equal to 400. Now, equity and liability. Equity and liability. As far as equity and liability is concerned, we shall write first of all equity. Under equity, we shall write share capital. I told you share capital of organization will come here. So we need not require to bother about anything else. So 50 crores is the capital of the organization. And then other equity. Again, other equity of the organization, first of all you write. Correct? When I say of the organization, 650, that is the other equity. And here in this question, first of all, Reserve and surplus are getting debited by 250, so I will subtract 250. Again, it is getting debited by 50, so I will subtract 50. So I will be left up with 350. Then I will write here liabilities. As far as liabilities are concerned, first you write non-current liability. Under the non-current liability, you have taken funds, loan funds. Sorry, we have not taken loan funds, rather loan funds have moved out. And as far as division X is concerned, there are no loan funds. So nothing will come over here. Current liability of Maxi division, which is still with us, and the current liability as per the question, the sheet is lying a little bit away and it is 100. So I will write here 100. Correct? Current liability, let me check. The current liability is 100. So I will write here 100. So 400 plus 100, that is 500. So 500 will become the total of your balance sheet. So this sheet I need not require now. Now we move over to the second step. As far as your second step is concerned, in this step, first of all, I will write here, what is the name of the new company? Mini Limited. Mini Limited. I'll prepare the journal first. Mini Limited has taken mini division. So your entry will be, first you will prepare the journal. They have taken over our mini division's property, plant and equipment worth 200. They have taken over current asset of mini division worth 300. They have taken over current liability of mini division worth 100. And they have taken over loan funds of mini division worth 100. And consideration which they would pay us is equal to 50. So mini division will pay 50. So 500 minus 250 is your profit actually, but I'm writing here capital reserve. That means I'm transferring the profit to capital reserve straight away. Balancing figure. That will be 250. Now, consideration they are going to pay, isn't it or not? So second entry will be regarding that. Consideration account debit. How much consideration they are supposed to pay? That is 250. So 250 I am going to write. And for the same they are issuing share capital. They are issuing shares. 250. Now we can prepare the balance sheet also. Balance sheet of Mini Limited. Mini Limited has taken over property, plant and equipment. 200 is the value. Very small balance sheet. They have taken over current asset. 300. So total will be 500. Correct? So after having done so many questions, I have already told you, now you must feel supreme amount of confidence to tackle any question in case if out of this topic it get tossed up in the examination. Equity and liability. As far as equity and liability is concerned, correct? First you write equity. Under equity we write share capital. Now you let me know what is the amount of share capital. Mini Division is a new company and it has offered to 50 crores worth of share capital. Consideration is 50 crores, not 250 actually. It is 50 crore. I have written here 250. Consideration is 50 crore. Extremely sorry. Sometime it happens. Correct? 50 crores. Then we will write other equity. As far as other equity is concerned, there is no previous equity and capital reserve is showing a credit balance of 250 capital reserve. So I will write here 250. Then second, liabilities. As far as liabilities are concerned, you write here non-current liability. Since they have taken loan funds, you will write here loan funds worth rupees 100. And they have taken over our current liability also worth rupees 100. 300, 400, 500. So that is how the balance sheet of this particular entity is given. Honestly speaking, in the examination, generally you are asked only till up to this particular extent. Honestly speaking, you will not be asked questions like this one, which I am going to put before you now. I will keep this over here. Okay, now suppose if I ask you some simple question. Could you let me know net assets of Maximini Limited before merger? What I am asking? Before demerger or merger, whatever you may call it. So before this arrangement, if I am going to ask you what was the amount of their assets and liability, that will give me net assets. It is very simple. We know that net assets is always equal to assets minus liability, or it is equal to equity. And equity means share capital plus reserves. Correct? So we know the amount of assets. If I will look into the balance sheet, here it is, Max Mini Limited. Now total of their asset side, you can see is 500. Actually, they have already subtracted current liability. So total 500, and one liability is there in the form of what else? Loan funds are there, isn't it or not? Loan funds are there. Actually, I will take it this way, otherwise it will become a problem. I will compute for you. Otherwise, if I will take it this way, you might not understand. See, actually, their assets are property, plant and equipment 300. And their current assets is equal to 700. So assets is equal to 1000. And liability, now we come over to, as far as liability is concerned, liability is 200 is current liability, and loan funds is equal to 100. So liability is equal to 300. So we may say that net assets is equal to 700. We can also find out net assets this way around. Net assets means equity. Equity means share capital plus other equity, or other equity means reserve and surplus. Now we have been given organizations 50 as the share capital and other equity as 650. So we can also find it this way around. correct? So what my point is, prior to merger or prior to this arrangement, the net assets were worth rupees 700, correct? And their total capital is equal to 50 crores. All figures are in crores. So if I want to know value, or should I say intrinsic value of share, intrinsic value of share is nothing but net assets divided by number of equity share. Number of equity shares. Now net assets prior to merger is equal to 700, and since we are having 50 crores and one share is of 10, I will say 5 crore worth of shareholders are there. So 700 divided by 5 will give me 140. So that means the value per share prior to merger is 140. Prior to merger is 140. This 140, what does it suggest? It means if you have invested in one share of this particular company, there are rupees 140 worth of asset to back up that particular share. That means the position of the company is extremely strong because you have invested in a share of rupees 10 each. And in case suppose this company gets liquidated, then this company is in a position to pay back rupees 140 to one share, which is of rupees 10. So position is extremely strong. Correct. Now, suppose if I am going to ask you to let me know post-merger values. Post-merger. When I am writing here post-merger means demerger. That means after the process of. What is the value? Actually, what is the position of post-merger first of all? Position is that one is Max Mini Limited. Now shareholders have investments in Max Mini Limited, and they also have investment now in the new company that is Mini Limited. You must not forget that shareholders have also become the members of the Mini Limited. Now post-merger, I am interested in finding out net assets of Max Mini post-merger. So net assets, or simply I will straight away compute the intrinsic value of share, which means net assets divided by number of share. So post-merger, so we had prepared the balance sheet. Now where that balance sheet is lying, that is the only question. Just give me a few minutes. This was Mini Limited's balance sheet. And post demerged balance sheet, this is Max Mini Limited. Okay, fortunately I got it. This is the balance sheet which we prepared under step number 1, correct? So we can see actually assets are 500 and liabilities are 100. So asset minus liability is equal to net assets, or we can simply take equity and other equity, that makes it 400. Either way around, the answer will remain same. So 400 is the value of the net assets. But number of shares will remain 5 crores, no doubt about that. Number of shares will remain 5 crore, isn't it or not? As far as Mini Limited is concerned, and we just prepared the balance sheet of Mini Limited, I will show it to you. This is the balance sheet of Mini Limited. And here assets are 500, liabilities are actually 200, or we can simply add 50 plus 250, 300. So net assets will be equal to 300. However, number of share again is 5 because even Mini Limited has issued 50 crore worth of share capital, correct? Now, if I am going to compute, because shareholder, try to understand, suppose you had invested in Max Mini Limited, correct? Earlier there was only one company, Max Mini Limited. And now you can see that there is Max Mini Limited, although it is having only one division. Besides, there is Mini Limited. That means now shareholders are also investors of Max Mini Limited and Mini Limited. Earlier, value of your share was 140. And now what will be your value? You will take the values of both these entities. Now, if the combined value of both these entities will be more than 140, it will be said that shareholders' wealth has increased on account of this process. However, if total combined value of investor will be less, then it will be said that investors are on the losing side on account of this process. Correct? So, if I will compute it now, it will be equal to 80 and it will be equal to 60. However, it is equal to 140. So, as a shareholder, you haven't lost anything. Even earlier, your share was worth 140. I should not call is at market value 140 because this value, intrinsic value, shows the worth of your asset in terms of asset. That means your one share of 10 was equal to 140 worth of asset. And even here, after this process, your one share in Max Mini Limited is now equal to 80, but because of your investment now in Mini Limited, you are getting extra 60 also. So total again will be 140. So out of this process, as far as impact on shareholders' wealth is concerned, nothing has changed. So shareholders' position is status quo. Is it clear to you? So sometime it could be asked in the examination, sometime it may not be asked in the examination. That's a different matter altogether. But the point is that we need to be aware of. So after having finished up section 2 and 3, now we can say with great confidence that we have completely and very comprehensively and thoroughly have covered each and every strata of the question which could be asked in the examination. So that's the way we have to go about when we do professional level, what we call study. And on such account, now we wrap up this particular session. In the next session, when we'll come up, we will be discussing in that particular session, and actually accounting aspects in the books of acquiring company. So far, we haven't discussed that. So that will be taken up in the next session. So till then, it's time to say goodbye from here.